Think everyone's just joining in now. Should be coming in from the waiting room. Welcome, everybody. We'll just wait for a little bit as people join the session. Quite a big registration list for today, which is really nice. Obviously, it's the star power of Joshua Robertson and Suzanne Faulkner. And everyone wants to do a bit of property development too, no doubt. Not surprising that it's quite a big registration list today. Just while people are joining, we're just going to test out the chat. Thank you for joining us all today. Before we get into the official content, and whilst people are just joining us, we might just get people to drop into the chat where you're joining us from today and what it is you're hoping to get out of the session today. That would be really good. So where are you joining us from? And if you want to share what you're hoping to get out of the session, hopefully we've got a few people here. Yep, great. Brisbane, no clients. I'm not sure I follow that. Lester, good to see you again, Lester. I think you were one not long ago. G'day, Naomi from Greystone at Noosa. I'm sure it is a spectacular day in Noosa today, no doubt.
My goodness, I see Laurie from Warwick. I'm a Warwick boy myself, Laurie.
There you go. Regional Queensland. Northern Rivers. Someone from Rocky there. Hello as well to all of the Xact clients that have joined us today. Great to have you on the session. Quite a few actually of our clients have joined. So I won't go through the names, but
No.
you know who you are, and we appreciate you coming along, and hopefully you get something out of this session as well. Righto, I think we might kick off because if you're anything like us, everyone's got heaps to do. So we might just get cracking with it. So I'll just share my screen. Okay. So let's go for it. So this session today is about property development for builders. I mean, if you're not a builder, hopefully it's going to be interesting for you as well. But we've sort of taken the lens today around those that are operating in building construction and running some form of a building capacity or builder's business. Today, if you haven't seen one of our webinars before or recognise us, Suze and Josh are both partners, as am I, at Xact Accounting. The real stars of the show today are Suze and Josh, who are eminently qualified to speak to this topic. And I'm just going to pop up from time to time with polls and help with questions and things like that. So really great to have two really strong experts in this field. Very quickly, just a little bit about Xact, if you don't know already. We have a bookkeeping division, which is all about, these days, system integration, job costing, those sorts of things. The world of bookkeeping has changed so much over the last sort of 5 years. It's very much about, like I said, system integration these days. What sort of tech stack are you using? And so those guys in our bookkeeping team are real experts in that space. Our compliance team, once hopefully we've helped you land a decent profit each year, our compliance, our tax team are all about trying to help you hang on to as much of that profit as possible in all of the wonderful ways that they have of approaching that. And then we have quite a unique service, which is CFO advisory. This is for businesses who have reached the size and scale that they really need to have a serious expert, finance expert in their team but probably not ready to have a full finance team and a full-time CFO. So they offer that service as a fractional service. Something that I think, is quite a unique service in the market. Our clients, we really just look after building and construction. I mean, we have a few clients outside of that, but we really do specialize in that space. Ordinarily, they're scaling up and trying to deal with all the challenges that come with growth. They often have a growth mindset. So they're interested in running better businesses, becoming better business operators themselves. And so that's why we see quite a bit of attendance of our client base on these webinars as they continue to level up their financial literacy. They recognise it's time for a specialist. So they've used a generalist accountant that maybe their father used or their friend or someone has recommended, but they are more of a generalist accountant, and it's really recognise it's time for someone who knows their stuff in this industry and benefit from having a finance running mate. They're great at looking after clients and running the build and project and teams and those sorts of things, but the finance piece is something that they recognise they need some outside assistance with, and so we play that running mate role in that space. Bit of housekeeping. So our agenda today, we're going to go through some really fundamental principles of property development, those core ones being CGT and GST. So we're going to do a little bit of a deep dive on both of those as first principles. We're then going to take people through the tax journey, or really it's the property development journey, starting out with just developing your own primary residence, where you currently live at the moment, all the way through to being a full-time property developer, and that's all you're doing. This session today is, as I said at the top, it's really for builders mostly, and for those who are looking to significantly improve the land and property. It's not so much for those who are looking for passive investments. This is all about getting in, doing a build, a development of some sort, and then a sale of an exit of some point. So that's who this is for. We're going to run a few polls along the way just to make it interactive. We're going to have questions. So if you have questions, please drop them into the chat as we go. We've just seen that chat is working, so that's great. The presentation is sort of broken up into little sections, and so what we'll do is we'll try and answer your question in the section that it relates to as we go. There is no such thing as a silly question. Please ask whatever is on your mind. It's a great opportunity to leverage the brains that are on this session today in Josh and Suze. So please ask any question you like as we go through. Also noting that we have an ebook that's coming out on this topic too. So a lot of the stuff that we've covered today, you'll be able to reference in that ebook that we'll share out to the audience. Along with, I should say, because we always get the question, we will send a copy of this video presentation and the tool, the feasibility tool that Josh is going to walk through. We'll send that after the session, hopefully this afternoon, if not early tomorrow. Righto, before we begin, we have to say this, which is this is not tax, financial or legal advice. We're going to cover this topic area today in a very sort of general way. We're going to make a lot of assumptions as we go. Please don't make any decisions until you have really had a deep look at your own specific circumstances, and we'd like to think that you would do that with a trained professional. So this is just a general advice today. Okay, we're going to run a poll to begin with, just to get a bit of a sense of where everyone is at in their journey at the moment. If I can just do my polls. Here they are. Okay, let's go. Where are you at? If we can just get a sense of where you are at in your property development journey. So the options we've got here, I've done some renos on my own house. I'm about to have a crack at my first development. Have been doing small developments for a while, so like splitters, flippers, that sort of stuff. Starting to get serious about my own development. So, up to sort of 50% of the revenue each year is now starting to come from developments, or I'm a full-time developer. The results, I'll share them in a sec, but they're looking very kind of evenly spread, although we do have quite a few highest ranking at the moment, people about to have a crack at their first development. Well, hang in there. It's going to be a fun ride. I'll share those results for you now. There we go. So that's where it landed. So yes, like I said, the most popular one there is about to have a crack at the first developments, and then have been doing developments for a little while. So we're sort of trending around the middle of the road there, which is probably what we expected. We've tried to include content for everyone across that full spectrum today. So it might be a refresher on some of the earlier content for some of you on the call. And then later in the session, you'll get some more value out of things once we get into some more complex matters. If it gets too technical in the questions that we're dealing with today, we're more than happy to do a one-on-one session with people. And that's a much better forum, because then we can consider your personal circumstances whilst we do that. Just before I hand over, though, to the team, we will be offering at the end of the session, you'll be have the opportunity to put your hand up for a one-on-one session with Suze or Josh, if there is anything that you'd like to discuss further. And again, that we can cater for your specific circumstances as well, rather than in this sort of general forum today. Okay, that's it from me. So we're going to kick off now with CGT, and it's over to you, Suze.
Thank you, Phil. And one of the things we don't want to do today is get you bogged down in technical mumbo jumbo. So when we talk about CGT, we're really just giving you a bit of a high level understanding of what CGT is and how it might apply in some of the developments that you're undertaking. So CGT, for those that may not be aware, is capital gains tax. Capital gains tax is almost 40 years old. If you're actually familiar with the dates, it's actually the 19th anniversary of CGT on Friday. So happy birthday, CGT, for those that are counting. Sorry, 39th birthday, I should have said, not 19th. So it's 40 years next year since we've had the CGT regime in place. It effectively is a tax that's attributed to the disposal of an asset. And in most cases, that relates to things like property, it relates to shares primarily, and sometimes some collectible items as well. So if you've got some fancy cars lying around, you might find CGT might apply to those. But we're not talking about any of those fancy things today. We're more here to discuss property and what that means. Now, interestingly, most of us are aware that when we have our main residence, it's exempt from CGT. What we don't all realise or don't always understand is actually your house falls under the capital gains tax regime. So any asset that you own, which includes the house you live in, is actually subject to CGT. Main residence or the main residence exemption is a carve out. So it's an exemption under the rules, but it actually is subject to CGT under first principles. So when we're looking at your main residence, the assumption that we have to make actually at first is it is subject to CGT. Then we have to look at, is there an exemption or a rule that carves it out and means that it is actually exempt from CGT? So that's where we're talking about a few things today. We will touch on a few of those examples. It can be quite complex, and there can be quite interesting nuances when it comes to, do I get a main residence exemption or not? You'll also probably be familiar with the CGT discount. So that's where you've owned an asset, so shares or property or some other type of asset for more than 12 months. You are entitled to a reduction of 50% on any capital gain that you've made before tax applies to that asset. Now, one quick thing to note in relation to the discount, it only applies to individuals and trusts. It does not apply to companies. So assets held in a company are not eligible to apply the CGT discount, whether or not you've owned the asset for more than 12 months in the company. It just doesn't apply. It's ruled out completely. So a couple of things in addition to what I've just said here. ATO clearance certificates. For those of you that have sold property, you may have already come across these. What it actually is the ATO a couple of years ago said, we're having some issues collecting capital gains tax, particularly from foreign residents. And so what they introduced was a system where we now have to apply and tell them that as a buyer or as a seller, really, I think it's the buyer side, you are not a foreign resident. So where you then are selling a property and the property value is more than $750,000, you have to apply and say, I'm not a foreign resident. Please don't withhold capital gains when I sell this property. So it's something that just to keep in mind as property prices have been increasing over the last couple of years, this is becoming more and more common. If you don't have one of these when the property is settling, then on settlement, there is an obligation, a legal obligation to withhold an amount in relation to what is expected to be the CGT amount on the property, which effectively is a how much is it, Josh? Do you remember? Gosh, it's not 10%. Is it 3 or 4%? I can't remember. Anyway, we can find that out. But basically, there is an amount that is withheld on settlement in relation to CGT. If that happens and you're caught in that, it has to go back to your tax return for you to be able to have that reimbursed if you're entitled to it. So it comes back to what you actually should have paid for CGT versus what you are actually being told you have to pay. So it's just being aware of those sorts of things. And we want to give a very quick example in relation to selling a main residence. So in this example, we're assuming that your income is at $200,000 per year, putting you in the top marginal tax rate bracket, which means that any income you have above that is going to attract 47% tax, including Medicare. In this example, we're saying you've got your main residence, you've lived in it for quite a number of years, could be 10, 15, whatever it is. You purchased it for about $1 million. You've developed it, so you've spent a fair bit of time improving, made some changes over the time you've lived in it. That amounted to 1.2 million. So your total cost, purchase plus cost, is 2.2. You're then selling the property now for 3.5, which means you've got a gain. So the difference between your sale price and the total costs is 1.3 million. That's what we assess as your capital gain. This is very raw numbers. There can be some other little tricky things that come into play, but effectively a very simple example. In this case, because you've lived in the property from the time you bought it to the time you've sold it, and all you've done in that time is live in it, you haven't rented it out, you haven't done anything else in that space, we're saying in that example that 1.3 million that you've made is tax exempt. You have no capital gains tax to pay on that. You get to walk away with 1.3 million in your pocket. So completely tax-free in that example. Now, this can be a little bit tricky where you've done other things to your property. So there is timing issues that we have to look at. If you're buying, developing and selling, there's things that can impact that. So lots and lots of different ways that main residence may or may not apply. Now, one example, if you've bought a new property, you've been living in your property and there's a crossover period, the ATO does have some guidance as to how long you can have both properties and still get the main residence on both. So just be careful, there is timeframes around that. There's also timeframes around how quickly you have to move into the property and establish it as your main residence to make sure that you get it from the day you bought it rather than at some future point. So for example, in that case, you buy the property, it's tenanted, and you've got to wait 6 or 12 months before that lease is up. You might actually find that that first part of the property is not exempt from capital gains and you're subject to capital gains on that. As opposed to you buy the property, it's tenanted, but the tenants move out at settlement and you move straight in. You've had it as main residence from the beginning. So there's different little nuances you need to be aware of in those cases, and lots of little things to keep in mind when you're looking at, is main residence applicable? When we're looking at buy, develop and sell, so this is where you might do a major renovation. A lot of people have started over the last, oh gosh, probably 10 years, 15 years or so. It's probably been happening for a bit longer, but more common in the last 10 or 15 years. People are buying a property, moving in, renovating, and then selling again. And then they'll buy another property, move in, renovate, and sell, and they keep doing that. So in our terminology, we kind of call that a flipper, where you're buying, renovating, and selling, and you're just continuously doing that activity. We get asked frequently, is there a magic number of those that you can do that are tax exempt because they're main residence, or am I going to be subject to tax? And the bottom line is there's no magic number, but the ATO is catching up on people much faster than they used to. And you find that if the first one, fine, it's your main residence, you've just bought it, you've held it, you've lived in it, you've renovated it, and you've sold it, exactly the example we just had. The second time you do that, might be okay. By the third time, there's a pattern developing, and there's what we'd call repeat activity happening in there as well. And our bottom point there, behavior being linked to intent,
what's looking like it's happening is that you're doing this to generate profit. And if you're starting to do it frequently enough and starting to generate profit over it, the ATO will start to look at that and say, this is no longer a main residence type activity. This is income producing activity. So you just have to be careful about how frequently that starts happening as to how much you might be caught in terms of having to pay tax on some of those activities as opposed to them being exempt. So it's just a little bit of a proviso there that you may end up finding out that some of those properties aren't. Now, coming a step back from that, say instead we've got an investment property. So this is no longer a main residence. It is a property that you've never lived in. It is an investment property only. You've held it for more than 12 months. So we've still got that longevity in place. Similar facts to before, the same costs apply, and we've got our higher income earner over the 200,000. So we've sold the property for 3.5, total cost for 2.2. Our capital gain is 1.3. Now, if you had held this for less than 12 months, that full 1.3 would be subject to tax. Because we've held this for more than 12 months, as we mentioned before, you get your CGT discount. So 50% of that 1.3 is exempt. So you're only paying tax on 650,000. Because we're in the top marginal bracket at 47% means you're now paying $305,500 as tax on that transaction. So you don't get the full 1.3 as nice cash in hand. You get the 1.3 less the 305. So just under $1 million is what you'll take home as profit after tax on that one. So you might ask, what if I did that in a company? Would I save myself some tax? Because, and a lot of people will think this might work, the corporate tax rate is 25%. Remember, we're paying 47% if it's in our own name and we're on that higher income. So when we say, okay, company tax rate 25%, would I be better off having done that in a company? Let's have a quick look. So we've run the numbers. The one thing that we have to remember in the company, as I mentioned earlier, we don't get that 50% discount. So the full 1.3 is subject to tax in this example, which means we're paying 25% of the 1.3, not the discounted 650. So in this example, we actually would end up paying 325,000 in tax. So even though you're on the higher marginal tax rate, you may actually be better off having it in your name from a tax perspective and paying about 20 grand less tax overall than if you'd put this into a company and lost that CGT discount. So it's a very, very simple example just to warm up where we're at and how CGT could apply in relation to property and in relation to some of these simpler transactions. We are going to kick across now to Josh, who's going to talk us through some of the GST side of things.
Yep. Okay, GST principles. So depending on where you're at in the journey, some of you will be already aware of the GST implications of property development. Some may be learning it today, but GST is an interesting part of property development. It's quite complicated, but I'm going to sort of simplify it a little bit today. But you may or may not realise that the large majority of property development, particularly in recent times, residential property development, GST is squarely in your net, and you must be considering GST as part of property development. And so one of the first elements to it, which you might be interested in off the back of what Susie just talking about with main residence. Now, there is a bit of a carve out. If you are doing your main residence and say we're not in this issue where maybe the main residence exemption is no longer applying, generally GST is not going to apply to you renovating your own home and selling it and making a gain. So just out of the gates, we just wanted to make sure that you weren't sitting there worried, oh no, I can't develop my own residence because GST is going to kick in. However, the sort of starting point with GST is, are you actually running a property development business or enterprise? Now, you might initially go, oh, if I'm just doing one, I'm not really running a business and an enterprise because I'm just doing one sort of flip property. But you have to be very mindful that the tax office has a very different view on this, because whilst you might think of business as, trading, big income, lots of expenses, even just doing a single development, buying a property with the intention of selling it for a profit, that in itself is very largely, most of the time, enough to tick the box for probably GST applying. Now, there's two main streams of where GST applies in property development. And the obvious one is the new residential build. So that's where you've bought something. It could have either been a clear bit of land, or you bought a bit of land with a property on it, flattened it, and built something brand new on it. Now, that was back in 2018 that they actually really caught up with new residential builds. So basically, if you've created a new residential property and sell it, GST applies to that sale. And so that also, the carve out, it's a bit complicated, but the carve out, as well as if you're sort of doing this at scale and you have a bunch of land and you're selling land that is potential new residential premises as well, new residential property, then GST may apply there as well. So just be thinking straight out of the gates, GST is likely to apply to development when you're playing in this space. A slightly less known area, and this is probably the area of most contention, is the substantial renovations area. So if you do a significant renovation to a property, so you haven't flattened it, you've just got it and significantly renovated it, there's a good chance that GST could apply when you sell the property. Now, there's been a lot of debate and there's been rulings and arguments with the ATO on this as well, on what substantial renovation is. And so what they're sort of getting at is the renovations need to, affect all or substantially all of the building being replaced. They're not necessarily saying you have to change foundations, external walls, etc. But it is definitely a grey area and something worth talking about ahead of going into one of those sort of developments and the GST implications as well. Now, some other GST considerations with property development. So say that we've already ticked the box on, okay, yes, we're running a property development business for the sake of the GST rules. And so if we're saying that GST is going to apply to any property development sale, then it follows that any inputs into it, so we call them input tax credits, but they're GST credits that you can claim on cost, right? So if you've got a whole bunch of inputs, including the build costs that have GST in them, then if you're going to be subject to GST on sale, then you'd be looking at claiming the GST on the actual inputs as you go along the project. So you're not out of pocket from that side of things. Really quickly, just wanted to highlight on rental properties in GST. If you do a development and ultimately end up, we're not talking about passive investment, but if it does ultimately end up as a passive investment and you end up holding a development you've done for holding and renting, that is, holding and renting for 5 years, then if you sell that property in 5 years and 1 month, there's a good chance that GST may no longer apply because it's no longer new residential premises. It's now just existing residential. But big word of caution on that, be very careful around that because it is an intention-based test. And if you're just trying to use the 5-year rule just to get around GST, the ATO can actually catch up on you on that. But the core part of GST, probably the not well-known aspect of GST and property development, and it's an area that's not well understood or completely missed and not appreciated, is what we call the GST margin scheme. Now, I'm not going to get too technical on the GST margin scheme because it is actually a fairly complex area of law, but it can be quite a helpful area in the GST law. And so it's the core part to the GST margin scheme is that it recognizes that a lot of property developers have bought land from private individuals or where the land itself never had GST in it in the first instance, right? So you've just bought it from Joe Blow down the road. He just owned this property, just a private individual. There's no GST when you bought the bit of land. So because they're going to apply GST when you sell it, because you're going to create a new residential premises, they don't sort of penalize you for the fact that you couldn't actually claim GST on the land. So there's a bit of a GST sort of reduction that you get because of that fact. Now, the best way to sort of show how margin scheme works is a sort of quick example of margin scheme. So we've got in a no margin scheme scenario, purchase price, bit of land, 1.1 million, has no GST in it. Now you develop the property, sell it for 3.3. If margin scheme is not applied, then the GST on that sale price is just going to be simply 1/11 of the 3.3. It should be 300. So you'd end up with net proceeds of 3 million from the sale of that. So that's net proceeds, right? Now, if we are actually aware of our margin scheme and how GST applies, and we do apply margin scheme, and there are some requirements around how you apply it. You can't just say that you're going to do it. You have the contract has to deal with it, etc. So say we've got same scenario, the purchase price 1.1, 3.3 sale price. How margin scheme works is it makes you pay GST on the margin. So the difference between the sale price and the purchase price of the land. So the purchase price, the important point here is it is just the land price. So it doesn't include stamp duty, any of that other stuff that's added. It's just the flat land value that you paid. So the margin between them, as you can see, 2.2 million, 1/11 of that is 200. So applying margin scheme, you would end up being 100,000 better off on a net proceeds basis by applying the scheme. Now, similar to what Suze was talking about with the ATO clearance certificates, there are actually some mechanics to GST and GST margin scheme as a property developer. So again, this was sort of rules that came around where property developers basically weren't paying their fair share of GST on transactions, and so there's a withholding mechanism that's in the tax system. So here's a scenario, quick scenario. So we've got GST, sellable property, sale price 3.3 million, again subject to GST. We're assuming the margin scheme is being used. Again, 1 mil private purchase. There was no GST in the price in the first instance. So the mechanics on sale, and the onus actually does sit on you, the property developer, making sure you do the right notification. So step one in the process of actually selling a property development. So you've done it, you're selling it, cashing in on the actual development. When you sell it, the person who is buying it from you is obligated to withhold GST at settlement. And so when you're applying margin scheme, the GST withholding rate is 7%. It sounds like a random number, but it has been calculated just to recognize how margin scheme generally works. So the purchaser will withhold 231,000 in this scenario and send it to the RTO. So you'll be 231 out of pocket on settlement initially. Step two is you actually do the calculation of margin scheme. So really quickly, 3.3 less than 1 million, the margin on that 2.3, 1/11 of that being 209. So your actual GST liability on the sale of that property would be 209, although the purchasers withheld 231 on you. Last step in that little mechanical process is you lodge the actual BAS, report your 209, you get a credit for the amount that that purchaser withheld for you. And so in that scenario, you'd get a sort of nearly $22,000 refund from the ATO around that sort of property development mechanics. So that's just some quick mechanics on the first principles. Now, we're going to move into the actual life cycle and the journey piece now, Phil, and I think you might jump on for a sec, Phil.
Yeah. So that they're the sort of first principles we wanted to cover off. As Suze and Josh noted throughout, there's just so many nuances to each of those tax elements, CGT and GST. But hopefully we sort of set the table a little bit there in terms of those being fundamental pieces of the puzzle. We're going to go through now in the second half of the presentation, we're going to go through these various stages of the property development journey, starting out with the castle builder, developing your own house. Side hustler is where you might have bought a house as an investment property and you're doing a renovation on that. How is that treated? Semi-pro, maybe you've got a number of developments on the go now. You might have starting to get into some multi-dwelling arrangements, splitters and the like. Multiplayer is where we're bringing in other parties, so JV arrangements from a funding or a building perspective. So there's a whole range of ways you can involve other parties in developments. And then fully pro, I saw in the comments earlier, there are a few people who that's their intention over time is to end up doing only their own developments and not having to have external clients. So we're going to cover off on each of these now. So Suze, we're going to go to you and you're going to talk about the castle builders.
I am, but I don't have a whole lot more to add here because we've really covered this as part of our capital gains example before. So this is where we've bought our own house. It's our castle. For those that have seen the movie, you would know exactly what we're talking about here with the castle. So, you know, and our intention here is just to live in it, to own it, to live it, and to get that capital growth and just enjoyment over time. And so really the bottom line here, main risk, we overcapitalize. We spend loads and loads of money on our house. We can't recover it. But, you know, that we've had the joy and the pleasure of raising a family there, or you know, just having that years and years of enjoyment in the place. So it's not a huge burden on our lifestyle or anything in that respect. So where we look to here is generally it's going to be no tax payable. It's your main residence, it's where you live, no tax. And generally we can get land tax exemptions as well. We won't be touching on land tax at all today, but we will just mention that it does apply in some of these cases. So it is something to take into account when you are looking at your activities. So yep, castle builder, bottom line is generally speaking, no tax. Phil, I think, are we back to you?
Quick poll.
Yeah. Yes, we're going to run our next poll here. So I'll just go back here, and here it comes. So here is the question. We just want to test the GST knowledge of the room. So I purchased an existing house and completed a significant renovation. It's my own house though. It's my, yeah. When I sell it, does GST apply? So we're going to just launch this one. There we go. So does GST apply? I purchased an existing house and completed a significant renovation. When I sell it, does GST apply? We've got a lot of people saying no. And 30% of people saying yes. Here we go. I'll share these results and you can speak to that there. So yeah, we had 36% of people saying yes, GST applies, and 64 saying no. Righto. So I guess the question is, if it's an investment property or if it's main residence, how does that distinction apply?
Yeah, and this is the interesting one. This is actually the one where the most contention comes up, because the significant renovation is a matter of how much is too much that flips it. And it's it's actually quite a lot of the time we actually see that scenario, Phil, where we sort of go no. And it might be the case that you do a renovation on an existing home and GST doesn't apply because it hasn't yet been significant enough for the tax law for it to be a GST issue. So,
or it could be your main residence where it does still fall under the exemption. So there are instances where GST still may not apply. But if it's an investment property, Josh?
Yeah, investment property, well, we come into that scenario of if you do that significant renovation and very shortly thereafter sell it, you will be then in the realm of answering the question on, were you actually going to hold it as an investment, or were you actually just going to make a profit out of the gates, or are you going to hold it for a longer period of time, and say, for example, as I said, 5 years and one month, and we might be in a different scenario. So all we're getting at here is it depends. Every single set of circumstances will change the outcome. So it's so important.
Correct. Yeah.
Excellent. All right, we might move on to the next one, which is
the danger zone, I like to call it. Side hustler.
This one always has a lot of questions asked. A lot of people, this is the space where you start. You're really starting to think about, I want to make some money off of property. I want to be able to do it in a smart way. And I know, and I've heard, and I've seen other people doing it and testing the waters with, oh, look, just buy something, maybe reno it, we'll sell it, and we should make a bit of profit off the top of that. And look, most of the time that works. The question here is around a little bit of what we've been talking about already. What's the intent behind what you're doing with the property? Is your intent to buy, reno, sell, make a quick buck? Are you flipping it? Are you renovating it to keep it for rental purposes? Are you doing something even a little bit more than that, where I saw one just yesterday actually, where a real estate agent is selling a lot It's already been subdivided. It's already got DA approval for two separate titles on this particular block of land, and there's a house on one. It's a very common scenario that we see. People will look at that and go, oh, that's excellent. I'm going to buy that. It's already got the DA. It's already got all of that sorted out. And then I can either knock that house down and just sell it, or I might just fix that one up and build something on the back. And it's just a small little development, but I should be able to get some good money out of it. And that's great. And it does happen. And a lot of people can make some good returns on those sorts of things. And this is where we say it's a bit of a side hustle. You're still running your own business. You're still maybe even employed or doing whatever it is that you do on a daily basis, but starting to dabble in this in a slightly bigger scale than just owning your own house. Normally what we see here in terms of structure, you could be looking at doing this in your own name. I'd suggest getting some advice around that if that's what you're proposing. You could be looking at a trust or even a company to undertake these kind of activities. And again, I would take advice and come and have a chat with us if you're looking at those type of structures and what you should be doing there, because A, you need to make sure your structure is set up before you go and sign a contract to buy something. And B, you need to make sure you've got the right structure that works best for you and your personal circumstances. Some people will find a company is a better structure, some people won't. So it's really a matter of looking at your own circumstances and working that through. In these sorts of situations, often we'll find that you're using traditional lenders and leveraging your family home for these type of investments as well. So you're looking at utilizing your existing lender or potentially another lender, but having that equity in your home to start is where most people find that they're moving into this space. What do we find are the core risks? Often people will get caught up in their projects and lose focus on their core business. So something might suffer in that space. Sometimes we find that people get partway through the project and realize it's going to cost me a lot more than I originally intended or originally thought. And we'll talk more about that later in the presentation when we get to looking at our feasibility tool as well and how you can actually better estimate what those costs look like. The other one we find is wrong structure. So a lot of times people will go into these with the intent of making money, thinking capital gains tax is going to apply, thinking therefore I'm not going to have much of a tax liability, find out at the end that actually I'm stuck with a big tax bill. And it wasn't because of lack of knowledge, it was sometimes just you're in the wrong structure. So there's a lot of things to take into account when you're looking at these things, and it can be quite complex. On the right-hand side there, you can see we've highlighted some of the tax implications or outcomes for these type of projects. In a company, again, it depends. You're possibly in these cases going to have GST, and you're probably going to be looking at income tax payable of about 25 or 30%, depending on what you're doing and your intent. If you're an individual, you're still likely going to have GST. Just because it's in your name doesn't preclude GST. And CGT depends, again, on what type of intent you've gone into the project with, and also whether you have held it for more than 12 months or not, whether the CGT discount may or may not apply. So there are some implications to consider. Land tax as well may or may not apply, depending on where you are and what land tax implications you have. That is something to take into account as well, because that can hit you and sting in terms of profit on your project if you're not careful with how those sorts of things are structured. So main thing with the side hustle is it's really, really important to take advice from the beginning. Usually when you're starting to think about these projects, not when you're halfway through the project. It's always easier to get it right at the beginning than it is to change things halfway through. So if you are in that space and having a think about these sorts of projects or getting started in that, now would be a good time to have a chat with an accountant and get some structure and some advice around what you're actually doing. Once you've kind of done a few of those, we find a lot of people start moving into what we call the semi-pro space. And this space is a little bit different. You're looking now at slightly bigger projects. So you might be looking at not just the single lot that's already got a DA approval in it for two titles. You might be looking at, I've actually found a lot now that I could split into 4 blocks or split into 5 or 6. Or you might find a lot that you think I can actually put 3 or 4 townhouses in here. And you're looking at those bigger projects where you are starting to move into that space where you might still be using traditional lenders, but you might even be moving into some of those second tier areas or even private funding where you could be considering having a mate or a friend or something providing some funding so that both of you are getting some sort of output from these as well. We find you're sometimes in this space less reliant on external clients. And what we mean by that is you might be not as active in your business. You might be starting to look at this as more of a, I'd like to do more of this long-term, bigger scale stuff and make that more of my focus. And you're probably looking in this space at becoming less investment focused, as in rental property type situation, and more in terms of just turnover. So getting the project done and completed and getting it off the books. So this requires a little bit more thought around structure, a little bit more thought around what the best way to make this happen is. We find in this case where people come unstuck a little bit is the lack of financial visibility. So you're going into these projects, you might be looking at it as, okay, I've got my contract in place, I've bought my land, I'm starting my development, I've signed up my builder, or you might be doing it yourself. And forgetting that you still have to track all of that, have your budget, have your feasibility done, and then tracking how you're performing against some of those things. So it starts to become a little bit more business-like, a little bit more structured and routine-like in terms of what you're doing here. You'll quickly find in these cases as well that your existing structures might not work or might not give you the outcome that you want. Consider tax. If you're sitting and doing these sorts of things as an individual, you're likely going to end up full GST and 47% tax on these projects. And it's not a pretty outcome when we get someone come in and say, I've got this 4 townhouse project I'm working on, it's in my own name, and they've got their own house and there's a whole bunch of risks associated with it. So it's hard to unwind some of those things once you get there. If you are using trusts at this level, it is important to also understand that the tax implications around trust really depends on where ultimately that money ends up or those profits land. So that can be quite different depending on who's involved in the projects. So semi-pro is sort of getting into that more serious semi-state. Very simple example that we'll have here, and what we start to see clients doing is whether potentially they are the builder or they've been running their own building business. You're still operating your business, and you will set up a separate entity that's considered or called your developer entity. So that's the entity that's buying the land, undertaking the project, securing the funding, but then you're engaging a third-party builder, or you might even engage your own entity to do the build on that project. And so you're starting to get a little bit more complex in the way that some of those things are working. Excellent. Josh is going to take us through even greater complexity as we move into
so we're about to shift it into another gear of next level developer now. So I don't want to go into too much detail in this, because this is actually where it gets quite complicated, but we just want to share some thoughts and parts and thoughts in your mind around where you might be at in your journey. So the multiplayer is where you and another party now starting to play in the sandpit. So largely the multiplayer is where you're trying to largely pool capital, share a bit of risk, as well as bringing different skill sets together to do. This is the other term that's usually used here is joint venture in the multiplayer, and joint venture is interestingly used as a phrase interchangeably. It means different things when it comes to structuring. So we will start doing the multiplayer when we're trying to do something a bit bigger or a bit more complex. So structuring is, I can't stress how much importance needs to be on structure when you come into joint venturing or multiplayer. And a lot of the time we've shorthanded that. SPV, special purpose vehicles, what we mean by that. Largely that's using companies and other entities in a strategic way to achieve what we need to in the project, as well as mitigating some of the risk. I will just highlight the joint venture as a concept is actually more complicated than the phrase might suggest. Now, a pure joint venture is actually not a scenario where you're trying to do this for profit. You're actually trying to do it and get some of the actual building units out of it. So say you and a joint venture partner come together, want to do 10 townhouses. Part of the actual joint venture deal is one party gets 5 townhouses, the other party gets 5 townhouses at the end of the project, and we move on. It's not necessarily for the profit. Capital starts getting very varied at this point. So sometimes you might be funding it, the shareholders might be funding it. Traditional lenders, particularly in high wealth sort of teams, will be turning up, like private banking, second tier funding, and obviously private funding as well. Risks obviously get a bit interesting at this level. So clearly the shareholders or joint venture partners could have a dust up and not agree. There could be some inappropriate or poorly designed contracts in this space, so not actually putting enough brain and mind towards getting the documents, contracts, agreements all in place before you dive into this. And of course, things around cost overruns and project delays. And obviously, if there's multi-parties involved, that can get a bit heated sometimes. And the similar sort of tax scenarios apply across company, GST, trusts. And again, we're not going to talk much about it, but land tax is an important element of this. Now, a multiplayer structure, what could this look like? This is an example that I've actually used on a live client. I've just de-identified it as well, where you've got someone who's got a bit of land. As you can see here, they want to do something a bit better with that land than just simply sell it and capitalize on it. So we partner with a joint venture partner who's also a builder. So JV partner 1 and builder entity are the same sort of group. And then we've got the landowner and JV partner 2. So you could have a scenario where you've got as we call it here, a PMA or a project management agreement with the JV partner 1 to run the project, collecting some of the costs through the builder. The builder then contracts with the JV partner who owns the land with a build contract, because you need to have a build contract. I put in brackets there a low margin build contract, and I'll come back to that point shortly. And it's largely just pooling resources, using someone who's got a bit of land and just stitching it together, and just to make sure everyone's getting the right outcome from a profit and project delivery. Now, the key point on all of this is making sure you have the right people involved, the accountant that knows how to structure it, the lawyer that knows how to put the agreements in place, etc. It all needs to be stitched together quite well for it to work and get the right outcome. Now, fully pro, this is where really, and I saw someone earlier was saying this is where they want to be, is basically not doing any more client work. I just want to do my own projects. And this is where all of your energy is going into your own projects now. You're no longer building for external clients. And so why do we want to do that? Well, we've seen that property development has the opportunity to make some seriously good money in it. And so as a builder developer, you get to enjoy both from the build side as well as the property dev side on the actual profit opportunity in that. Structuring gets quite complex in here, and that it also then starts to really center around where you're getting your funding from. And so source of capital, that's sort of nearly all the ones above, but you might at this point be self-funding. So you're no longer using external funding, and you can use third parties to it. No longer using third parties, and you can do it yourself off the profits of previous. Risks, of course, you're then going into one basket of your own jobs. So obviously high capital in there, project timelines. Obviously, then you are completely exposed to market fluctuations, interest rates, land values, etc. as well. And depending on structure, tax outcome will flow. Largely, we want to keep this sort of scenario in a company arrangement, but it depends on each circumstance. And again, the ever important, do not forget about how land tax applies. It applies differently in every state, and you do not want a surprise from land tax. So quickly, here's a structure where you might, when you're fully pro, you want to segment your risk, but also get your opportunity. So we sort of, very common structure to have the builder, obviously separated from the development company. We use special purpose vehicles per project. The main reason around that is separating risk. You don't want multiple projects in one entity. If something goes wrong on one project, you don't want it taking out the other project. And I did talk about land tax. There is also the concept of, if you want to do this as a full-time gig, you might look at land banking. So you might want to buy land and then eventually get to develop it. There may be a strategic way of holding it in trusts as well, just to manage things like land tax, spreading risk, etc. as well. So when you're at fully pro, there is quite a few ways you can cut this, but this is a very common way of structuring for people who are very serious about property development. Now, that's basically the end of the life cycle. So we just wanted to go a little bit deeper on this idea of the builder developer margins, and that you actually do need to be acutely aware that you are running two separate businesses essentially. So one, you're running your building company, which has required margin, needs to wash its overheads, etc. But you are running another business, a developer business as well. So we don't want to just gloss over the fact that there is two very distinct elements to this. So in the sort of building company scenario, depending on where you're at in your journey, but we want to be having our building companies in a scenario where we don't have an enormous amount of overhead in them, but if we do still have a reasonable overhead, if we're going to do property development, we need to make sure that we are covering all of our bases and not leaving a scenario where your builder entity is in strife at all, and making sure that we're getting a balance between the builder and the development entity as well. And so how that all links into all of this is it's a bit of a funding, bit of tail wag the dog scenario here with the funding, in that you don't want a scenario where you're using third-party funding and your build contract includes an enormous margin over to your build company. The key reason why, very simple reason why, is you pay interest on development debt as you use the facility. So if you're pumping up the margin, the build entity, and putting those claims into the funder, you're going to be incurring interest faster in your project because you're using more of the capital quicker. So you have to get a good balance in this. And the best way we can sort of demonstrate this is here's the two scenarios. The first one being, if you're not a developer, this is really where you'd probably be landing. So traditional resi builder, I'm just going to caveat that it's a resi builder. External client, you're not a developer in this case. So say we've got a $1 million build. Again, we're going to make the assumption that the builder is running a nice, clean, well-oiled machine where gross margin is running at 20%, net margin at 10%, and our overheads at no more than 10%. So this golden sort of 20, 10, 10 sort of golden rule. So if you're building $1 million project, 80% of its cost of sales, then you're expected probably to get 100,000 profit or 10% off the back of that. And that's about what you would make as a builder doing that contract. Now, if we go then flipping into, now, if I'm a builder developer now, well, how does this look in terms of margins? How does that translate through to development? So similar scenario again, where the builder entity, here's the build contract to actually build this new property. And so the total value of the build, including your overheads and profit that you want to make at the builder entity, that all translates now down into the development cost of sales. So the top section here, this is the builder entity. Now down the bottom, the full development is then laid out. So you've bought your land, 700. There's some development costs in there, and that's including some of the infrastructure costs, holding costs, some council stuff, as well as interest on the debt, which I'll show you shortly in the feasibility tool, how that sort of translates. Then you can see here that total build cost of 1 million drops into the development entity as if it was cost of sales at the development entity, and then ultimately running out a net profit on the back of the development. So builder developer, what's the upside here that you can see, all the opportunity that you're creating by doing builder developer is, ordinarily you'd be looking at making 100,000 out of just doing a build on a home. Was if you're going to do this as a development, you got the opportunity to make 500,000 out of that whole process because you've controlled the whole development as well. So that was just a bit of a visual representation of, what is the upside in this? Why do you do it? The margins in it for developers, 15 in this example is basically the minimum we'd want you to be making. In terms of developer margins, it's very common to be up and over the 20s, even into 30s as well, just as you're capitalizing through the land opportunity as the way you're doing the development. Now, I'll just take a quick second. So we're just about to go through the back end of the presentation now. So we're nearly finished now, guys. So the big thing that we promised in the webinar was our feasibility tool. So just bear with me for a sec. I'm just going to stop sharing and flip over, because it's a good opportunity to walk through the tool that we have, and just making sure that
just while Josh is doing that, just a reminder, we're going to share this tool that Josh is going to walk through after the webinar, along with the recording for the whole webinar. And again, we're going to offer a free consultation for anyone who wants to do more of a one-to-one session, so we can get into the detail that is often required in these sort of scenarios. So over to you, Josh, and we'll do this walkthrough of the tool.
We'll do the walkthrough of the tool. You can see that on the right. Okay, so there's obviously a bit of data on here, so I'll just walk through how to use it. Largely, you can focus your energy on blue as input cells when you're using this tool. So let's just work through this this tool, the example that I've got here. So we've got, just quite simply, entering in your project, start date, or estimated start date. Based on your program and understanding where you're at, you obviously, there's some lead-in time periods that you can put in here. How long is it going to take to build? What's the settlement period after we finish the build? So we're saying this project, as an example, being 13 months from beginning to end, and then it sort of maps out an end date. The importance of that is in the cash flow, which I'll show you shortly. So say we've done our research and we're doing a feasibility on this, and we've identified this. We think we can, based on all our research, we can sell this thing for 2.7 Inc GST. Now, this tool is quite clever in that it will automatically assume that you're using things like margin scheme already for the GST. So it'll take your sell price, adjust for margin scheme. Quite simply, the calc is what you're selling it for, less that land purchase price, assuming there's no GST in it, like the example earlier. Less some agent commission, so you can play with your percentage here on what you think you're going to be up for in selling it. If you're running it yourself and trying to sell the property without using an agent, as possible, generally an agent would be involved, because you have to be careful that selling interest in real estate may be a licensed required activity. So we've got a net realization value in this. So then through this feasibility, it walks through what are all the costs. So just like you would in a build contract, you've got to estimate the costs of your project, just as well to make sure that if I put all these costs in, is it even going to make any sense to sell it or even do this in the first place? So put your land price in, costs, etc. in here, and it is just an example. You play with it. It does provision a little bit here as well for some infrastructure, depending on the scale of your development. Council are possibly going to require you to contribute to infrastructure. There is then the construction cost, so being a builder developer, so that's where your build component of the feasibility you put in there, so how you would estimate doing the construction of that new premises or new residential building. There is a bit of a contingency built into this as well, just in case. And then there's other areas around architects, town planners that you can put in here as well. It does look at holding costs like rates, water rates, all this stuff as well. And as well, don't forget that there is always cost involved in trying to take one of these projects to market. So don't forget around things like marketing budgets, etc. So what it does is it calculates down here, total development costs. Again, it'll assume largely the inputs in your project will have GST on them. Obviously not this element here, but largely they will. Council rates generally don't have GST on them. That's why it doesn't select that as well. So we've got GST credits that we can claim because we're doing this as a project, as a property development project, and we're clear that GST is going to apply. So we're going to claim the GST on the actual project. So what we end up with is a development profit before finance costs here. And so it's quite simply, this is what's going to cost us X GST. That's what we're selling it for, X GST, right? And other selling costs. The profit of 559. The tool down here gets a bit clever in terms of how you do funding. So a lot of the time, and I actually can't stress enough about the importance of getting the funding right in making sure you're using the right funders, as well as brokers that play in the property development space, on how funders actually fund project development. They usually look at what the realistic gross realization value is as part of working it out. I've just put a 65% LVR loan to value ratio in here. And so what this does, and I'll just take this out, it sort of flags in here as well to give you an idea of what you're going to have to contribute to the project in your own funding and capital to make sure it works, knowing that the development cost or the development LVR they're only going to fund up to a certain area. So you're going to have to tip in some funding. And then it does take into account some of these other costs as well, which Lester, you raised a little bit earlier, around where you put them in. So interest rates, line fees, etc. as well, any establishment fees, puts the full cost in. So boils down to, in the end, development profit after finance cost is about 404 in this scenario, just based on those inputs and facts. So it does just a quick calc on here. What's the return on cost? So the cost of the total project, what return do you get on that? This is running at a 15% profit. No, Emma, I just saw that GRV. Sorry, I did shorthand that. GRV is gross realization value. It's linked up to the top here. Basically, what are you selling it for? What are you likely to sell your project for? So that's the high level on this. Quickly on the cash flow, I won't spend too much time on the cash flow because I know we're at 11:06 now. But what it does is it uses the inputs from the front screen and just does a bit of a map out on the cash flow of the project. It does do a bit of a straight line on the construction. I know construction is not straight line when you build, so you would play with some of the inputs in that, but it just gives you an idea of how the costs up front around land particularly, as well as it starts to step out a little bit what the cost of debt starts to look like down the bottom here as well. Encourage you all to have a bit of a play with it. Obviously, Susan and I are open for any questions post the webinar around how to use the tool as well. But definitely be thinking about your feasibility out of the gates before you dive into a big project, because the missing a cost, a major cost as part of a development, could be quite a horrible outcome. So yeah, can't stress enough on the feasibility. Cool, Phil.
Excellent. Thanks, Josh. We're getting close to the end here, so I just wanted to. We're gonna take some more questions in a second, but I just wanted to share. We've got some more events coming up. Hopefully, you can see that slide there. I think there's a few tickets left for our Master Builders Xact Accounting Spring Golf Day. If you're in Brisbane or Southeast Corner, come and join us next Friday. That is. We're doing some training for Master Builders online on the 10th of October. We're going through that fabulous topic of QBCC minimum financial requirements. Our next webinar for Xact Accounting webinar will be from our Xact CFO advisory team. They're going to do a special masterclass on job costing, one of the most important functions and accounting processes that you really need to have in play if you want to defend profit on your project. So that one, will be sending out details on that. And we have an accountant in the house, which is really where you get, an hour free. We set up at Master Builders there in Brisbane, and you can come along if you're a member and get an hour free with one of the team. Just wanted to quickly run, as I said before, we're more than happy. The team are more than happy to offer a free consultation for anyone who'd like it, to do more of a one-on-one session. I've just launched that now. Rather than you scanning QR codes or getting in touch with us, the easiest way to do that is just to say yes to that question there, and we'll get in touch with you after the event and arrange a time that works for everyone. Yeah, there's quite a lot to consider with this sort of stuff. You don't have to be a client of ours for that session. We're more than happy for anyone who's registered to do a one-on-one session for you guys, anyone who's interested. Just while that's happening as well, we have a survey. So when you click out of the webinar today, you should get a survey. I think it's only 3 questions. We really like these sessions. We want to make them better and better each time. So there's just a couple of quick questions there, as well as some suggestions on topics that you might want us to cover. So let us know what you'd like us to cover on the next round. So more than happy to get feedback though, just so that we can continue to try and improve these webinars for everyone. Any final questions from the audience before we wrap up? I don't know if there's any that have come through. Again, we'll be sending around the video. It's so detailed, all of this stuff. So we've really just been able to do quite a light touch today, but hopefully it's, you know, been thought provoking for people. You've come up with a few ideas that you'd like to run down. It is, we can't give financial advice. We're not financial planners, but it's a bloody nice way to make some income in property development. But clearly there's a fair bit to make sure you get it right from the tax side. And then our friends in CFO Advisory will give you a lot of hand and help to make sure that you're running these projects profitably as well. There's a question there from James. Losses, any strategy to claim deductions there? Who wants to have a crack at that one?
There are options. It is a wee bit complex. It depends a lot on the circumstances, how the losses were generated, where they are, and what you've got coming up. So it is something that you would definitely need to consult on to get a bit of a strategy around how that might work.
Yeah.
The key thing around it, just to be a tricky thing with property development, is when you're doing the development, largely the costs that go into it form part of what sort of like property development trading stock. So a lot of it is sort of parked until the end of the project, but that's a very general approach to it. There are other areas as well that you could claim potentially.
Danielle,
James has just added. James has just added in relation to GST, losses in relation to GST. Again, the GST is separate to the income tax. So if you are working on a project that actually is subject to GST and you are able to claim the GST, that won't impact you just because the project is generating a loss. So you still are entitled to claim those GST credits as you go through. But yeah, again, it's always important to just have a bit of a chat with your accountant or come and have a chat with us, and we'll see if there's something better we can be doing to help you in utilising any losses or GST credits, etc., that you think you may be able to claim.
Yeah, you might a little nugget, James, for you to think about is consider property development entity registering for GST on a more frequent basis, like monthly.
Yeah.
So you can get credits back faster.
And the other is to consider, often an accountant will just set you up with GST on a cash basis. It's not always practical when you're doing these projects. So really consider whether you register on a cash or an accruals basis, because it can be a big difference in terms of cash flow.
Substantial.
Danielle's question there, Josh or Suze. How have you seen people structure it when someone has the land and the builder is doing the build and organising finance? How do they structure the profit split?
Oh yeah, I love this one actually, because I
think that's where the contracts and the arguments come in, isn't it, John?
That's where all the arguments are, Danielle. Well, that depends on what you're trying to get out of it. So that structure I showed you in multiplayer is this exact scenario of that client didn't want to do it as having a joint entity together. And so they've done a management agreement where the builder, in this case, is basically running the whole project, and the person who has the land, what they basically do, they call it a fund-through arrangement, Daniel, where basically the landowner permits the builder to do what they need to do and have access to the security of the land to get the funding, etc. It's all just stitched up in the agreement. They call it a fund-through agreement, but that's just basically the importance of agreement. The alternative is, and so there's no sort of standard way. So is there? The other way is that the joint venture people come together in a single entity, like a unit trust or a company, and from there they split the profit. So it completely depends on the relationship, what you're trying to get out of it, and how the land and funding is being stacked. 100%.
Yeah, correct. And in some cases, it can just be that your agreement might be, I just pay back the funding first, and then we split the profit after that. So there's lots and lots of different ways of doing it.
Elmet has their hand up. Elmet Champy. I'm not sure if that's to ask a question or an accident, but more than happy for you to join the conversation if you wanted to, Elmet. Otherwise, we're going to treat that as a accident there. Okay. I think that looks like it's it, and some people are sort of leaving anyway, which is great.
Phil, Elmet has just popped a question in the Q&A box instead of the chat. When buying
Sorry.
a land with building, then you renovate and then you're wanting to sell, is it subject to depreciation for tax purposes? So it depends. If you're holding the property to rent it, you may be subject to depreciation, and you would need to engage a quantity surveyor to do that for you to determine what eligibility you've got for depreciation on the property. If you are buying land with a building and renovating and then just selling it, then no, generally depreciation is not going to apply.
There you go. Thanks, Elmet. Okay, I don't think, unless I've missed anything, which is always possible, I don't know if there's any other questions there.
I think so. No, it's good feedback, James. Have a good play with that tool, James. If you have any questions, reach out. Go deep on it.
Yeah, absolutely. Yeah, I mean, even if you want to reach out, we can just do a separate walkthrough with you on that tool. We're more than happy to do that.
100%.
Okay, great. Thank you so much, everyone, for
Thanks,
joining
everyone.
us. Thank you, Suze. Thanks, Josh. Very informative as always. And yes, if you're interested in reaching out, please do so. You can find us online at our website, Xact Accounting, or we might see you again at our next webinar, which again is a masterclass on job costing. Our CFO advisory team will be running that one. All the best out there. I hope you're doing well. If you need a hand with anything, please get in touch. But otherwise, we'll see you down the track.
Have a great day.
Yep,
See you
thanks,
guys.
everyone.
Thank you.
Bye-bye.